Happy Wednesday and Happy New Year. It is 2026. Josh and I are back here with the Educated Homebuyer Live uh, to talk about housing, to update you on what's happening in the economy.
Jeb, you're going to love this. I don't know if you can hear me, but I'm hearing nothing in my cans.
There we go. Can you hear me now? How about now? Josh, there we go. Hello. Hello, hello. All right. Welcome, guys, to the Educated Homebuyer Live. This is 2026. We're doing this 5.5 years. And we're here tonight to answer your mortgage and real estate questions, guide you through the home buying process while educating you and having some fun while we're doing it. Josh, are you here? Can you actually hear me? He's not staring at the screen. That's a problem. But can you guys hear me? I got a yes. Got a yes. You would think after 5.5 years of doing this, we would be fine. They're saying, Josh, go back to your other headphones. All right, guys. Well, this might be a short episode if we've got dummy Josh over there just staring at the camera, not doing anything. Is he frozen? Is he like, what's going on over there? All right. So you guys are live for Instagram, on YouTube as well. How the show typically works is if you're new to this, we go over some charts, tell you what's happening in the economy, talk about inflation, employment, essentially what's impacting mortgage rates. We also touch on mortgage rates. And while we're doing that, it's always a good time to put in your questions. And that way, as we come out of that, we can actually answer them and move on. But I'm just looking at Josh here, wondering what he's doing. What he's doing, people. He's gone. Josh disappeared. So it's going to be me tonight. So you're welcome for that. Anyhow. All right. So let's do this. We're going to wait for Josh to come in. While we're doing that, let me know where you guys are watching from. I know we have probably some new people tuning in tonight since it's the start of a year. This is typically the time of year where people start thinking about home buying, whether it's a resolution, something they've been on the fence about. And a lot of people come in here and want their questions answered. And tonight we are going to do that. But with me is normally my guest there, so we don't have any questions. So I'm just going to talk here. This gets really weird, especially on Instagram and some other places, because you can't see the actual questions pop up in the chat as you can on YouTube. All right. Josh, you're killing me, my friend. You're killing me. All right. So let's see. We got somebody here. Let's see. We got Aurelius saying, watching the show in my own home thanks to Josh. This is amazing. So Josh would have loved to see that, but Josh is having issues there. Asking about refinancing, yes or no. So here's the thing. When it comes to refinancing, it's all about kind of, whether the numbers actually make sense or not, right? What you're trying to accomplish. There's oftentimes to when it's smart to refinance, and there's times when essentially you should stay put. But for the most part, at the moment, rates have trended lower, right? So Josh's formula, if you will, is if you take 125,000, you divide it into your loan amount, that tells you about how much you need to save in order for that refinance to make sense. So, for example, if your loan balance is $250,000, you divide it by 125, that means you need to save about 0.5%. If you move up to 500,000, you need to save about 0.25%. If you move up to $1 million, you need to save about 1/8%. But that doesn't necessarily mean it always makes sense, right? Because you got to look at the costs that are involved when going through that refinance, and pencil out whether or not, kind of a cost benefit analysis, right? How much are you saving from that refinance versus how much are you paying to actually do it, right? Take that number, divide it, take your savings, divide it into how much it's costing you. That's going to tell you essentially how many months you need in order to recoup that cost. And when you start getting in this environment, when the idea that rates are going to probably trend lower, not significantly, but are probably going to trend lower, I don't know that I definitely wouldn't be paying points in this environment. But I wouldn't be looking at a cost probably over 12, 18 months of some sort of recoupment period, whether or not it makes sense. But that's something that Josh, mortgage professional, can actually run you through, run the numbers. There are times when you can actually do a refinance where there's no cost involved at all. Well, there's cost involved, but it's essentially a credit coming back from either the lender in some form or fashion, right? You take a slightly higher rate than the best interest rate out there. They give you a credit back to cover those costs, which is essentially what I do when I refinance. That way, if rates do continue to trend lower, I can take advantage of those opportunities as they become available. That way, I don't feel like I'm stuck in an interest rate, right? When people are paying points or paying a lot of fees in order to refinance to a certain rate, as rates move lower and it would actually make sense to refinance, a lot of people don't feel like they should or they can because they've paid all this other cost up front, essentially a sunk cost. So we're going to add Josh back here. Josh, can you hear me?
I can hear you perfectly.
Hey, welcome back, Josh. Welcome.
Yeah, it's because I heard you perfectly until we got on air and it just dropped out.
Well, welcome to 2026, Josh. It's a new
2026. Did we figure out, Jeb, is this episode 300 yet?
I don't know if it's episode 300, but we started in June, or I started initially in June of 2020. You jumped in and out of there for a little bit, but we're going like 5.5 years at this point of almost every Wednesday answering questions live on the internet. So it's been a journey here.
Jeb wants to go back to the 2-hour episodes that we did for the first 2 years. That's his preference.
Those are not my preference.
The
only
question
because
volume has to support it.
Yeah, only because the questions are very repetitive at that point. But Josh, we had a question on refinancing, yes or no. Just kind of went over when it made sense. I don't feel like we need to jump in there and have that conversation again. But we did have Aurelius, I believe Aurelius, jump in here saying that he was watching the show from his own home thanks to you and talked about how that was amazing. So congrats.
Well, I absolutely appreciate that. That is fantastic. So what I would say on that refinance or no question, I had a question with a listener earlier today that had reached out and they could drop 1% in their interest rate. But they said, well, I've been looking and I'm seeing some forecasts are saying that by June rates are going to be lower. It's $1 million loan. We can drop the rate 1%. So the answer in that situation is take the money and run. Try and do it low or no cost. And if rates are lower in June, as some suspect they may be, then we're at a point where you can look at doing it again. But I don't think anyone with a large amount of savings on the table should turn a blind eye to it. If you're having to pay a bunch to get an interest rate that makes sense, you're giving up a bunch of your equity for a marginally lower payment, maybe we wait and see what happens next. But the numbers never lie. And if the savings is there now, I wouldn't overlook it. And Jeb, we did an episode of the podcast just on Monday talking about our interest rate forecast and talked about a lot of the experts and what they're saying and what they're thinking.
Fair enough. Just going back here, is Aurelius Marcus
Doswell?
Is it? Because it says it will go down as the craziest home purchase deal ever.
I'm certain that would be Marcus coming in under another alias. Marcus, comment in here and let them know. We will definitely, other than your name, keep everything.
Well, we've already given the name at this point.
Well, it's Marcus. We didn't. Well, shit, we screwed the whole thing up.
No, we didn't give a last name.
Okay, so if you can just comment that it's okay to share some of the details, because there was some no fault of your own, some interesting stuff that I've never seen in 30 years. I don't think Jeb has ever seen in 25 years. So 55 combined years. What happened with Marcus's situation is you guys have all heard of wire theft, where someone sends in their money to escrow and hey, that's not the real money, and it's in Eastern Europe and someone is having a grand vacation on the buyer. Well, that's not what happened. Marcus got the correct information, wired his deposit over, and as best we can figure, someone at the escrow company got on the wrong side of a phishing scam.
But hold on, escrow received the money. So escrow had the money in their bank account. It never went to anyone else. So that's typically how wire fraud works. It goes to another party. At this point, the escrow company was holding the funds.
And someone there got on the wrong side of a phishing attack and gave up the passwords to the account, and the trust account where everyone's funds, not just Marcus's, where everyone's funds are held, was hacked. and hundreds of thousands of dollars went away. And longer story short is that escrow company is at least temporarily, if not permanently, out of business. An escrow company had been around for the better part of 40 years, had 3 or 4 locations. This wasn't a fly-by-night operation, but the state has an overseer of, depending on, escrow companies can be overseen by a couple different state agencies. And whoever it was in this situation came in and shut them down, took everything over. We got really, really fortunate in that Marcus's seller wanted to get this done and was very cooperative. And they both ate some of the loss in the short run. And they're hoping that they will recover most of it, either from the state or from that title company, that escrow company. Some of the funds have already been recovered, not all of them, but they're all sitting there being held for now until it all gets sorted out. And some, or hopefully all of those funds, get refunded. But it ended up, what did Marcus talk about, like an extra 10 days, 12 days? We were able to sort of repackage it, redo it, and make it work. And it was less painful than I thought, putting it back together for a large deposit disappearing.
The fact that everyone stayed in the process is crazy to me. Like, I mean, I respect it. I think it's fantastic. I just can't believe everyone held on as long as they did. And it will go down as the craziest story I think that I've absolutely heard. There's so many details here we're not telling for other reasons, but there's a lot going on. And but either way, congrats on getting in there. And yeah, good news for you. And appreciate you being a part of the show and trusting us through the process. I mean, good thing you had a Josh on that side to be able to walk you through that, because you truly needed it.
Well, we talked about the value. We talk about the value of pros all the way around. He had a family member representing him, longtime realtor. The realtor on the other side was a pro, and the seller didn't freak out when he easily could have and gone a different direction. And to save a weird, crazy situation like that, it absolutely requires everyone, buyer, seller, agents, lender, being on the same page. And the new escrow company put it together real fast.
Good stuff. So what we're going to do now is something we typically do at the very start of the show, but because Josh pulled a Houdini and disappeared, we didn't have him. So we're going to talk about some charts now. While we're doing that, do us a favor. Let us know, start putting your questions in the chat now so that as we come out, we can answer them for you. But Josh, the charts are going to be short tonight. There's not a lot happening. It's the beginning of the year. Through this chart in there, just basically showing you inventory ended the year as it always does, towards the lows, not the absolute lows. It definitely started the year lower than where it ended. But it ended at the lows, higher than the 2024 volume, still lower than where we ended in 2019, which is essentially what we expected, up 13%. Year over year. So at the height of the market, we saw that gap between 2024 and 2025, 22, 23%, I believe, at some point. But we ended it with, at the all-time lows, and mostly due to seasonality and what was expected. Here at Huntington Beach in Orange County ended at 2,785 homes. And Huntington Beach right at 170. Actually, these are numbers today. So they actually ended a little bit lower than these numbers. But we started the new year, and so this is the data from the new year. So we are actually down a little bit week over week from Orange County. So 2,785. So we actually ended the year slightly higher than these numbers. We're actually seeing those numbers continue to decline as we head into the new year, which isn't abnormal, pretty normal for that. But Huntington Beach actually saw a jump of 12% from where we ended the year. I think we ended the year at 148 homes. Now we're sitting at 170. So decent sized jump. It's basically the week before the end of the year, we were at 170. We dropped to 148. Now we're kind of back up to 170. So maybe some of those people pulled their homes off the market, came back on, maybe some new listings, what have you. Either way, saw some activity since our last live. We've had employment reports, we've had inflation reports, and today we actually had ADP come out, Josh. And what do we see there?
We got ADP and Jolt. So ADP was positive, which we're in alternating months here of literal job losses per the ADP data. So it was 41,000, and I think they were expecting 52,000. So a little bit of a miss, not a whole lot of bright spots in there. If I had stretched this out back to 2024, you can see a definite downtrend in the number of jobs being created. There's some debate on what the replacement rate is right now. How many new jobs do we need to fulfill all the people of of coming of age and wanting a job to keep the unemployment rate stable. But this is definitely trending down, not looking positive. The next chart, Jeb, here is looking a little bit more useful. This is still that left side of the chart there is the beginning of the data. So ADP back in the middle of October started doing a weekly number, and it's a 4-week moving average. Moving averages are great because they sort of smooth out the data. And you can see we had 4 consecutive weeks of job losses on that 4-week moving average, and it's slightly back positive again. So this chart isn't super helpful. Give us by middle of the year, give us middle of next year, and it'll be really helpful when you can kind of see how it changes over time. But it seems to be telling us we're not creating a whole heck of a lot of jobs right now. We also got the JOLTS data, Jeb. Last month was a little bit higher than expected at 7.45 million, went down to 7.15. Really clear from looking at this back to 2023, the downtrend there. It's been sideways to slightly down over the last 6 months of the year, to really the whole last year. And the reason why this one is important, or what we're looking at, if you have a lot of unfilled job openings, then the people who are out there looking for jobs get to pick and choose, and they get paid more, and that's inflationary. So the Fed looks at this. That's an important data point that we got there today. This was from another report, Bruce Melman, that I follow his stuff. He's the king of PowerPoint and charts. And this shows pretty clearly unemployment is 4.6 up from 4.1 in June. You can see that chart. That has been, job creation has been trending down significantly. November, 64,000 jobs. October, loss of 105. September, 108. August, minus 26,000. And when we look at this, we still have sort of the fog of war from the government being shut down and not having a lot of data. So that was what I found interesting about this. Jeb, I would have to be honest here that I paid zero attention to trueflation during the time since we were on 3 weeks ago with the last show. And that is a big improvement. Inflation's fallen off a cliff per trueflation. And normally you could say, well, this is a blip. But if you look at that chart back, over the better part of the year, that's about as quick a drop as you've actually seen in it. And January will be interesting. If we end up at the end of January with that number still low and trending down like that, it will be very interesting. Because January, you get some of the numbers reset. And even a couple of the Fed speakers this week, Jeb, were warning that, hey, we may end up with hotter inflation reads in January and February due to some of those resets in the data. But this sort of corroborates, you mentioned, we finally, with the government reopening, we got a CPI figure and it came in way lower than expected. And everyone's like, whoa, take this with a grain of salt. They had to impute a lot of the data because they weren't able to collect it during the shutdown. And that is true. We need to hold off. We need to see what happens over the next month or two. But Trueflation, which collects a lot of the same data, is looking and seeing some of the same information. This is the Cleveland Fed's nowcast of inflation. And the important thing to look at, I highlighted all these numbers because they're low relative to what we have been seeing. If you want to see inflation at 2%, you can have about 0.16, 0.17 in these monthly reads. And we had been consistently 0.25, 0.28, more consistent with 3%, slightly over 3% inflation. And if you look, all of these are under 0.20. And we look at the reads here expected for December and January. You see CPI at 2.57 and then down to 2.24 in January, 2.58 on PCE, down to 2.38 in January. It does appear that one-time price increases due to the tariffs has kind of worked its way through the system, and hopefully we begin to see lower inflation. So we started with jobs. If jobs are coming down and unemployment goes up over 5% and we get anywhere near a 2% inflation read, the Fed will cut more aggressively than what is expected at this point in time. And regardless of what the Fed does, the bond market will react with lower yields than what people are expecting right now. This isn't super important, but I thought it was an interesting look. The market is projecting no moves in the first quarter from the Fed in terms of cuts, and then one cut in the second quarter and one cut in the third quarter. And then interestingly, the futures market is saying just nothing till 2027. And there's a possibility of that. Again, Fed cuts do not equal mortgage rates. They don't equal the 10-year yield. And both of those can move lower in the absence of Fed cuts if where the Fed is at is deemed to be neutral and that we don't need additional stimulus. Through this in here, this is the chart of the 10-year. Forget the day-to-day movement, but we've been really range bound since all the way back into September. So we're going on 4.5 months of rates not really going anywhere. The one chart I didn't get to pull in here, Jeb, is spreads continue to move lower. Depending on the day, you run them under 2% for the first time in the better part of 2.5, 3 years. And if we continue to see that and the 10 does break lower, we could see rates surprise to the downside. Not projecting it yet. I would like to see a couple more months of data, but you can see here Mortgage News Daily is reporting everything green there. The daily change, weekly change, monthly change, yearly change. And the year change is pretty significant. 6.19 on the 30-year fixed. It's almost a full percent lower than where we were last year. That will have an impact on sales volume, days on market. Inventory won't build as quickly. Again, that's not a sea change. We're not seeing a 5.5% rate, a 5.25% rate that would really change and augment the market. But if we continue to see that, it will be positive for real estate.
All right, good stuff. So let's see. We have another home buying workshop coming up at the end of January, January 27th. This is where we walk you through in about 90 minutes. It's live on the internet. You don't have to come and attend it. It's done basically via StreamYard here, and it's an opportunity to learn what the home buying process looks like from A to Z. Walk you through, getting started to essentially, how to navigate it. I don't know how many people we've probably done 400 to 500 over the last year up until now. We had 7 people buy last year that took the webinar, the workshop. So it's a really good opportunity if you're starting. It doesn't matter if it's later in the year, when you're starting, just to go through it, understand the process. Again, it's free. It's an opportunity, again, to educate yourself so that you know what to expect. So there's a link at the bottom of that there. But if you go to theeducatedhomebuyer.com/workshop, it will get you to the sign up and put your information in there. You'll get the link and some reminders along the way.
Jeb, some good news. Did we do this? Was it late November or early December when we did this for the early birds?
December.
To be ready
December.
To go. So
yep.
Beginning in December. Docs just went out today for the first buyer of that group. Seriously.
Wow.
Closing Monday. So Doc's out today.
Crazy.
He had done a lot of the legwork up front, went through everything, reached out, scheduled a call the next day. We went through everything. He had talked to 3 or 4 other lenders there locally in Ohio. The numbers we were able to put together made better sense for him and just hammered it out.
Fantastic, dude. That's awesome. So already getting ahead. So if you're interested, again, just throwing it back up there, educatedhomebuyer.com/workshop. We'll get you in touch with us and we can guide you. You'll be part of the live there and the workshop and some incentives and all that good stuff. So hope to see you there. All right. So Josh, now moving along and starting to answer some questions, the reason that a lot of people show up. But Josh, we did a forecast a couple weeks ago where we talked about all the housing market stuff. We talked about home sales. We talked about rates. We talked about inventory, demand, all of the things. But tonight's episode is the idea of here's where home prices are headed in 2026. So Josh, a couple years ago, Bill McBride from the Calculated Risk wrote an article about the 7 years of purgatory. This whole idea that because the housing market had gone up so much in such a short period of time, that there was a high likelihood that we see 7 years of purgatory, if you will, 7 years of little to minimal appreciation in the housing market, more or less to allow appreciation to catch up to the long-term trend that we've seen nationwide of about 4.6%, here in California about 7% or so. You need sideways movement because you need interest rates to moderate, hopefully come down. You need wages to increase and home prices to stabilize. All those things increase affordability. So with that said, Mr. Lewis, just thoughts of 2026 home prices, rates. Let's just assume rates stay where they are now and move between our forecast of say 5.75 and 6.75%. What do you think happens with home prices nationwide?
So I refer back to the concept of animal spirits. There was a book called Animal Spirits, and in economics, animal spirits is
Are you a unicorn?
no, not a unicorn. John Maynard Keynes in 1936, in the General Theory of Employment, came up with this idea. And it basically refers to and describes the instincts and emotions, basically human behavior. And what we saw in 2020 and 2021, the animal spirits were running wild. Everyone felt great. I got to buy, and they get out and they go. And then it corrects. And once they ebb and you don't see that, it doesn't come flying back in. So even though this could be the best year in a few years for buying into the market, I don't know that we're going to see a huge uptick in appreciation. If you told me we ended the year absolutely flat, okay. If we're down 1 or 2%, yeah, I could give you a scenario for that. I think rates are going to trend better. I think the economy is going to hold up reasonably, even though unemployment is likely to tick up. And we'll see somewhere 1 to 4%. If we were north of 3, it would probably surprise me. So let me say my base case would be 1 to 3% appreciation, but could be flat, could be down, especially if rates don't trend lower or the economy takes a turn for the worse and people don't feel good, largely because where we're at right now, you just don't have that mania where everyone feels pressure and feels in. Like, sellers have kind of gotten the message that, hey, you better price right. People aren't going to come in and make this offer hand over fist and give you whatever you want. And buyers have also got the message, hey, I can take my time. I don't need to make pressured decisions. I don't have to have FOMO. I can do the right thing. So I think we're kind of in that period where, obviously, really nice updated homes, the nicest home in the neighborhood, it's going to sell for a premium. The nasty house in the neighborhood, it's going to sell at a discount. Most of them are going to have to be priced appropriately to sell because buyers are just no longer in the mood for overpaying for stuff.
Agreed. Yeah, I think you see moderate appreciation, 0 to low single digit numbers, 3%, 4%. In most markets out there. Some markets, obviously, low inventory, Northeast markets might see some more. Some markets might see some decline just because of inventory and insurance issues and a lot going on there. But I think overall, when you're looking at Case-Shiller, CoreLogic, all the big numbers out there, you're in the low single digits somewhere. So more or less flat. And when you talk about real home prices, adjusted for inflation, maybe slightly negative in some markets.
Well, Jeb,
Yep.
that was the big picture takeaway in McBride's article about 7 years in purgatory, saying we're not likely to see outright drops in home prices, but you could see several years of real home prices dropping, where home prices do not keep pace with inflation. And it's looking like, we'll see what the final numbers come out with for 2025, but with inflation up in the 3% range, probably didn't get 3% home price appreciation. So you probably saw nationwide, which, take it for what it's worth, doesn't mean much to you if you're not living nationwide, but you probably saw real home prices decrease. And you get 4, 5, 6, 7 years of that, and you see normalization of affordability. And one of the things that Bill also likes to point out regularly, and people don't want to hear this or don't want to remember it, the graph of affordability slopes upwards. It's gotten less and less affordable over time. So that doesn't mean that you just say, oh, this giant spike in 2020 and 21, that's the new normal. It is not. But homes in the future are likely to be less affordable than they were in the past. So when we normalize, it's not down to that same baseline of 1982 or 1976. It's going to be a new normal that is less affordable than it was before.
Agreed. All right. So we got some questions here, Josh. One's a good question. It says, are we stuck in a cycle in the housing market where rate cuts increase demand and prices leaving affordability unchanged? So, Josh, there's this idea that the rate cuts out there are essentially driving, I guess, lower rates is the way I would take this. But let's just take a more bird's eye view. Are we stuck in a housing market at the moment? If rates stay here, move down, which is what we would like to see, are we stuck in this situation where it does increase demand and affordability remains a problem?
So take it for what it's worth, but anecdotal, one man, one person, a team, if you consider it you and I, that things come through your YouTube channel. But you would ask, where were we this time last year? So normally for me and most people, especially in colder weather climates, you come through, things slow down pretty heavily around Thanksgiving. And so there's not a lot of new loans going on the board, whether it's purchases or refinances through the end of the year, which means January is very slow for closings. You generally have a lot of closings through December, but then the closings slow down in January. Well, that's the exact opposite. We have, what did I tell you? Probably like 6 times the number of January closings of what we were going to have last year.
Mm-hmm.
And last year wasn't a good year. It wasn't a terrible year. At the start of the year, inflation ticked up and rates shot up, and people were already not in the greatest mood because rates had shot up from the first drop when the Fed started that cutting cycle in 2024. So long way of saying, we're seeing more activity, more volume. We're likely to have more sales this year. But to his point, does that mean that home prices are going to go higher and so affordability won't be improved? I'm not necessarily seeing that. The people that I talk to, I've had a ton of phone calls this week. We have a bunch of people that we're getting figures out to get them pre-approved. And like the overall theme from them is, we think this is the time is right for us because we're seeing a more balanced market where we can get out and feel like we can negotiate and get something normal. So affordability is better. If this time last year rates were over 7% and we're just over 6%, that's an improvement. No one loves that. You know, someone told me today, he goes, yeah, we bought our first house at 2.75. My current loan's at 7.5. We're going to refinance it to a better rate, but the 6.25 doesn't sound great to someone that had 2.75. So do I think that? I don't think that even 5.5 leads to a mania where buyers are like, I can afford so much more. Let me rip out there. The mindset is still anchored to what would my payment have been if I had bought in December of 21 instead of today, no matter what happens with rates. If rates went to 4.5, I don't think you have this mania where prices get crazy. But from your end, how does it feel?
I would disagree with the last part of that. I think rates start getting 5 and below. I think there's a mania to some degree of people are like, I'm not missing out on this again.
But
like,
you have also said, Jeb, that to your point, there would be a mania of sellers going, oh, hell yeah, I wasn't doing it at 7, but I'll do it at 4.75. So don't you think the supply demand? I just feel like there's this tension, this balance there.
Yeah, sure.
That,
I mean,
that volume would go
that.
up. I don't know that prices would go up.
Hard to say. It really is. I mean, it truly is hard to say. I mean, I think we're at a point where affordability has become a sticking point, right? I mean, and you know, being in this business for as long as I have, every year people tell me, "Hey, dude, I know I'm buying at the top. I know I'm buying," and they've been telling me this since
for 10 years.
For 10 years, I know I'm buying at the top, and every year prices continue to go up. And I'm not saying that to say we're not at the top, and I'm not saying that to say we are at the top. But what I would say is that, you know, you become adjusted to the new norm of whatever that home price, that payment is over time. And I think there's still room for prices to go up, just not in the way that they have over the last 5 years. So I think there's a lot of people sticking on the sidelines that would love to see lower rates that would drive people off the fence. So you start getting low enough in rates and it does increase demand. What it does to home prices, hard to say, but I think it starts, that flatness that we are expecting, the trend definitely starts to go up with appreciation. The more buyers you add in there.
Yeah.
I mean, at least in my head. So I don't know.
It will lead to an improvement. I don't think it leads to craziness where you're like, we missed the window. We got stuck in 3 years of awful, and then now the window closed again. I just don't feel like that's coming. It may not stay.
I don't think we're seeing those rates anyway, so it's kind of a moot point at this point.
Agreed.
For now. All right. We got another question here, Josh, asking. I'm going to answer this one real quick because I feel like this is an easy one to answer. Just says, is it a good time to sell for downsizing? So if you have a house and you're selling it and you're buying another house, kind of all the same market, right? Wouldn't you say? Regardless, now if you're selling something and staying put and then buying later, then you're trying to time the market, do some other things. But if you're selling and buying at the same time, essentially the same market, regardless of how you look at it. So what I would say is it a good time to be a seller? It is in most markets out there. I think, as you move further into the spring, inventory is going to pick up. Typically that time is sometime towards mid to late February, through early part of June is when you see the most inventory come to the market. It's the hottest time of the year because that's when the most buyers are out there in the market looking for homes. It's when demand is at the highest. It's when you see the most appreciation in any given year, looking back historically. So with that, I do think it's a good opportunity to take advantage of the market if that's your goal. But when you're downsizing, what are you downsizing to, right? What's out there in the market? Have you seen it? What is it priced like? Payment wise, how does that look? I mean, all of those things need to be factored in there because that helps make the decision, right? Do you have capital gains, right? When you're selling, how much equity do you have? Are you going to be taxed on any of that stuff? All of those things need to come into the equation when you're considering selling your property, and not just worried about, hey, should I be timing it right now? I mean, if you're going to sell in, say, 2026, I think the next 4 to 6 months are probably the best time of the year. Doesn't mean you can't do it later in the year. Just this is the time if so you need to start thinking about it. But just my 2 cents. Josh, talking about loans, would you take a builder's loan over a private loan? I'm not sure what the private loan is. Builder's loan.
I think he just means
from
from not a lender, not the builder's lender, a bank,
say from a broker, bank,
else.
whatever. Yeah. So what are your thoughts there? You come across this often?
It's almost impossible to justify. What I tell people is, prior to post-COVID, even through COVID, we would blow a builder's lender out of the water 8 days a week and twice on Sundays. Like, just cool. Talk to them, get their terrible terms, and then we'll give you the real terms and we'll get this thing closed for you. As soon as they started having to incentivize buyers, I mean, the numbers are builders' margins, gross margins are like 30%. They're down to 20% now, because about 10% of that margin is going to concessions to buy the rate down. So when you look at that, they will also, it's all smoke and mirrors. You're not getting anywhere near what they claim you are getting, but it's still massively better than any outside lender that you could go with. We've used this example before. My friend bought out here in Riverside County about 2 years ago, and we had her pre-approved, ready to go. And she goes out, puts a builder, a new construction under contract over the weekend. She goes, okay, this is what the builder can do. They're going to give me $18,000, and this is my interest rate. They're going to use that money to buy it down. We went through it, that it was really $12,000. And they say, they're lying to you. It's 65% of what they said, but I don't have $12,000 for you. So you probably should take their free $12,000. So that's what it boils down to. I would say 9 times out of 10, in the last year, I think we did 2 new construction loans, and they were unique situations. The one, the buyer had some leverage and said, I want to use my lender and I want the concession, and we got it. And the other one, there wasn't much of a concession and they hated the builder's lender. So in the vast majority of the situations, you're going to go with the builder's lender and take the money.
Understand. As the market, if rates come down, depending on where you're located, some of these incentives are going to go away, and it's going to, it's not going to be as sweet of a deal as it is when the market's slow and these builders want people participating. I mean, the same goes for agents, right? When the market's slow, they don't want to work with agents at all. They don't want to pay us compensation. They don't care about us. But as soon as the market slows down, they start building inventory. Guess what? We start getting emails, calls. Hey, we've changed compensation. We've upped it to X plus this, bring your buyers in, because it's all market driven, right? They're not in the business of holding on to homes. So understand, I don't think this is going to be a gangbuster year in real estate where, we have 6 million home sales. But I do think home sales are going to pick up over last year, probably sitting in the maybe mid 4 million range, if I had to guess. And so if that continues, just pay attention, because some of those incentives are going to go away depending on where you're located. If you're in a market that has a ton, then it's a different story.
To close the loop on the example that I gave, where we never lost deals to builders, which now we never take a deal from a builder, is exactly what you said. As long as they're not doing the incentives because we love this. We've built this into our business model.
We love you clients. We're just going to,
you guys are the best. It's like we do what we have to move these units because we can't sit on them. If they're moving without the incentives will go away, and they'll go away as quickly as the builders can get rid of them.
Good stuff. All right. So Josh got a question on Instagram. She didn't put in here the detail, but it says, hey, Florida Realtor here, curious about the headline we just saw. I'm assuming we're talking about Trump potentially banning institutional investors from buying single family homes, is what I would guess that headline to be. Yeah. Josh, we actually recorded an episode on the podcast today where we talk about this in detail, some of Trump's policies, what it means in 2026. But in short, let's talk about the whole idea of a ban on institutional investors. Can he actually do it? What does it require? And could it have an impact on single family homes?
So an outright ban is hard, but they can change tax policies. They can do any number of things to disincentivize this purchasing. And so you got to ask yourself, everything with the government, Jeb, what do we always talk about? Cool. They start out with the best of intentions, but there's unintended consequences. If you change this, I mean, you can unchange it, you can unring that bell at some point in the future, but it's important to remember, where did all of this start? It started in 2009 and 2010 when no one wanted to buy homes. So institutional investors were the buyer of last resort. Fannie, Freddie, FHA, VA owned a bunch of homes they did not want to own, and no one wanted to buy them. And hedge funds and big investors were able to say, we can make a return on this. We can raise a low cost of capital. We can put it to work, and the rent yields make sense for us. And the thought always was that they would sell those back into the market, 2012, 2013, 2014. They'll get some capital appreciation when the market normalizes. They'll make a rent yield in the meantime. They'll sell these back into the market. It never happened. Rates stayed really low. They were making such good appreciation. The rent yields were so good. They said, we'll just sit on them. In most markets, it is not a major part of the market. If you're in Atlanta or you're in Phoenix, and it is a big part of the first-time buyer home market, you don't want to hear that. So I get it. What I would say is it's more likely to be changing tax policy and some things versus just outright saying, hey, if you're a corporate entity, you can't buy homes. I also think that the path from an idea to actual policy is a long and difficult one. So we'll see how quickly it can happen.
Well, also, I think there's confusion in who's buying homes, right, Josh? You know, the large majority of home buyers of investment property are actually small mom and pop landlords. They own less than 10 properties. They own a few properties here and there, right? That's the majority. The institutional investors, the one that owns over 1,000 homes in the market, only equates to 2.5% of total volume out there in the market. So does it matter? Sure. It matters in more areas other than other, right? Than some, right? Southern California, are we worried about institutional investors coming up and buying thousands of homes? No, because it doesn't make sense financially. Because what are these guys doing? They're buying them, they're renting them out, they're producing a yield on the cash, because most of the times it's some sort of portfolio that they have to provide some sort of yield spread back to the investor, right? So where does it make sense? It makes sense in the Southeast, right, where homes are more affordable. We're talking Florida, Louisiana, Alabama, like some of that little Sun Belt area there.
Atlanta's got
Texas, Atlanta, parts of Arizona, like where it made sense. A lot of these areas don't make sense anymore because prices have gotten so far out of whack in relation to rents that it doesn't have the impact. Now, if you ban it, is it going to change things? Yeah, I think it probably impacts new construction, which we saw today when that was announced. New home builders were getting hammered out there. The REITs out there in the market were getting hammered because, hey, this is, you know, a negative impact on us as a company. But, you know, you take it for what it, you know, Trump says a lot of things. What's actually going to happen?
You don't say.
What's actually going to happen? That's to be determined.
Well, Jeff, the one thing that struck me with it is something very new just over the last couple of years, last 3 or 4 years, is the build to rent. And okay, so you can say that corporations can't buy. I can't stop a corporation from buying land and building homes to hold out for rent. And maybe you can. The government could, in theory, do anything they want, but that is a difficult task. So it's not quite as easy as it sounds to stand at the podium and say it, but it is something that definitely gets traction with voters, especially younger voters who would like to buy a home and are seeing themselves priced out in their market. So it's more win the press conference than win the war.
Yeah, I mean, I understand that, you know, when they're talking about institutional investors buying single family homes, they're not talking about homes off the MLS, right? That very, very small percentage. These days, back in 2008, 2009, yeah, that was happening because they were packaging these things up in foreclosures and selling them like that. That's not the case right now. So it largely impacts new construction more so than anything else, which is going to impact, you know, sales volume on new construction. I don't know. I don't know what it means for the housing market. Could it open more opportunities for home buyers? Potentially, in some of these markets out there. But you have to understand also what, you know, home builders are in the business of making money and making profit, right? So they're not necessarily building all of these homes at a quote unquote affordable price point where the majority of people are looking. And so I'm just, devil's advocate here.
Just play a little game along that devil's advocate line. We talk about unintended consequences. So if you bought, let's say that they ban this and you're in Atlanta, Georgia, and there's a significant market for them to buy that is no longer able to buy. So there's a little bit less demand, same amount of supply. Home prices drop 3%. If you bought in 2020, 2021, do you care? Home prices are up 35, 40%. You're like, yeah, that sucks. My home dropped 3%, but you're not that mad. If you bought in 2023, 2024, 2025, and home prices have been relatively flat, and now the equity you built over the last 2 years is gone, and you were a 3% down conventional, 3.5% NFJ buyer, you're going to be furious. So it sounds good to win the press conference to the people who don't own a home, but the people who recently bought and bought at elevated prices are at risk anytime you do anything to improve affordability by trying to manipulate home prices lower. So it still may be the right decision, may be the right thing to do in some way, shape, or form. But again, I always go back to saying those buyers performed a very critical function when they were the only buyer in the market. So then to 15 years later saying, hey guys, we don't want you here at all. Definitely put guardrails up around it. Do something. I'm not the politician. I don't know the exact answers, but to just say no, I mean, what happens if 20 years from now we find ourselves in another position where hedge funds are the only buyers and need to be buying again, or they need to help the government in some other way in some area, and they go, remember when you guys burned us on this? So lots of potential for unintended consequences.
Yeah, again, a lot of unknowns at the moment, right? Just Twitter or tweet, goes out and the world's set afire. No, I think it was, not a tweet this time. It was actual statement made, but nevertheless, a lot of unknowns at the moment. So I think continue to talk about it as we know more, and I'm sure you guys will have questions around it. So that's the best we have for now. Josh, let's see here. Question here. I don't know that I truly understand the question. I think I do, but it says, we have our home paid off to buy another house. Do we need to take out a loan, then sell our house and then pay off the loan? Is this feasible? How's it done now? So I'm assuming all of their equity's in their property now. They don't have the money for the new house without selling that house. So how would one do it if they didn't want to sell it first?
Well, okay. So how about this? Why don't you say, how does it normally work? If you want to buy, you own your home free and clear, you want to sell and you want to buy without a lending solution to make it possible to buy the next home. What does it normally look like?
Well, you would normally have to sell that property, right? So you would do it one of two ways. You would either put that home on the market, get under contract, or potentially even sell it, negotiate some sort of rent back or potentially move. Now you have the money in your account, and go out and you buy a house. That's one way to do it. The other way to do it is essentially some sort of contingency where you're simultaneously closing both the sell of your property and the purchase of the other property. So you're selling your home with this idea that, hey, I need the equity from this property to buy the other one. There's some contractual language that needs to go in there to protect both sides of that. But essentially it's a contingency. That would be the quote unquote normal way to do it. Now, that aside, Josh, there are things out there called bridge loans and some other products that allow you to do exactly what he's asking here, or they're asking here, and saying, hey, listen, I'm going to keep this home. I want to buy something else. How do I do it? And I'm going to pay that one off afterwards.
So let's look at it. That home's paid off. Now let's just pick a number. It's $400,000 home. If we want to buy a $300,000 home, you could do an 80% cash out refinance, get $320,000 less any loan fees, and now I can go be a cash buyer. And then when you sell that house, that loan gets paid off and it all comes out in the wash. But most people are moving up, and most people aren't free and clear. But if you're moving up, no one's going to loan you 100% of the value of your home. And even if they did, if you have a $400,000 home, you borrow $400,000, you go buy a $500,000 home, we still need more money. So what the bridge loan does in this situation, let's say you have a $400,000 home, you want to buy a $500,000 home. The bridge loan can give you cash out. There's like a bridge HELOC where they know you're going to pay it off with the sale of that home, but they'll make the loan on the new property using some of the money from the old property as a down payment. You can cross collateralize them where the loan goes against both properties. Now we've got $900,000 worth of home, and maybe we need $450,000 worth of loan. Lenders will do that. So it's much more complex, and it really depends on the strength of your qualifications. Can you qualify for the mortgage on the new loan? All of those things come into play. So you really need to talk to a lender that understands this and can help you and guide you through all those options.
All right, Josh, question from Instagram. What's the max DTI allowed for conventional and FHA?
So 50% conventional, but not everyone gets it. It is per the actual written guidelines are much lower than that. The automated underwriting can go up to 50% for most well-qualified borrowers above 700 FICO, 5% or more down. Generally going to let you go. Even 3%, oftentimes with a well-qualified borrower, will be able to go to 50%. On an FHA, 47% on the housing to income ratio, plus another 10%, 57%, including all of your other debts. But it's important to know that if you have no other debts, you can't go to 57. It's that 47% housing to income ratio. And we've talked about it before a million times. VA doesn't have a max DTI. USDA has made it really, really difficult. So they have an income limit, and then they also reduced their housing to income ratio from 34% to 29% in the fall. So tough to qualify at 29%.
Agreed. So hopefully that answers your question. Let us know if you have additional questions here streaming on YouTube. Also on Instagram, just trying some things out, see if people actually watch this sort of thing over there. So if you have questions, make sure you throw them in. We'll try to get to them. We do this every Wednesday from 5 to 6 p.m. Pacific Standard Time. As I mentioned at the beginning of the show, I don't remember if I was talking when no one could hear me or when you could hear me, but 5.5 years been doing this since June of 2020. So we've answered a lot of questions, helped a lot of you guys, and appreciate you guys still showing up and being part of the show and contributing, because without you guys, there would be no point being here. So we appreciate that. Josh, another question. We kind of addressed this today in the podcast that we recorded as well. But after Powell is gone, his term is up at the end of May. There's a high likelihood that Trump announces the new Fed chair within the first month of January, just based on some things I've read. That said, I mean, he could wait until the end to do it. But either way, after Powell is gone, will the housing market be better for first-time home buyers is the question.
So Powell answered this himself, right? At the end of the last press conference, someone asked him a question about housing. We don't have the tools to fix that. It's a structural supply shortage. The Fed does not have the tools to change that. So our president and many of his appointees seem to believe that putting someone else in that office and having them put their thumb on the scale and push rates lower, regardless of where the market thinks rates should be, would be a positive thing. I don't, Powell's not relevant to housing and whether it's good for first-time buyers. And I don't think whether it's Kevin Warsh, is Kevin Hassett, they got three, we narrowed it down to about three folks. It doesn't matter. It doesn't matter who they are. The two Kevins and another dude, and whichever one of them ends up as the next chair of the Fed, they can make things worse. They cannot do anything directly themselves to make things better.
All right, good stuff. I don't think there's much to add to that. Question here asking, if you filed a Chapter 7 bankruptcy and it's discharged, can you get a conventional loan or an FHA loan, Josh? How long does it have to be discharged for either of those?
You asked the critical question that wasn't in their question is yes, you can, after a waiting period. So FHA is 2 years from discharge. So not from filing, from discharge. Conventional is 4 years. So Fannie and Freddie, they have language in the guidance for extenuating circumstances, other than like having cancer and running up $200,000 of medical bills and being able to show that it was all that and related to not being able to work and not having insurance and you had to file BK because you had no other option. Extenuating circumstances I have never seen. I'm sure it's happened before, but I have literally never seen it.
All right, good stuff. We're at the end of questions for now. If you have a question, now's a good time to throw it in there because you're kind of first in line, right? It's always good.
They're last in line.
Last in line.
First of the last.
Yeah. Philo. First in, last out. Now let's be last in.
LIFO. Last in, first out.
Yeah, there we go. Last in, last out.
You can tell Jeb and I took our accounting 101 a long time ago.
Too good. I suck at accounting, by the way. I've
Oh,
determined that. Holy
so
cow.
you're what, 7 years younger than me? Did they still have those stupid, the ledger paper, and you
Oh,
have to
yeah.
do that crap, or was it all computerized by the time
No, it
you?
was all paper.
I don't think they make kids get that stupid accounting paper out anymore. I think you get to do it all in Excel.
Yeah, it's crazy. Yeah, it's crazy. Even software is crazy, dude. Just how it's complicated. Some things are just complicated. It's complicated. That's why you got CPAs and, you know, bookkeepers and that good stuff. I'm a computer science major, Josh, and I don't know how to do any. I mean, like Chat GPT could do what I learned in college now. So I
Jeb,
would be
I
irrelevant.
just coded a great piece of software today. We'll know it looks like it works. I will play with it some more and let you know if it actually works.
Too good. Where are we? The show's just going downhill at this point. So here's what I would like to push. I would like to mention this because there's more people here than there were earlier. We are doing another home buyer workshop on January 27th at 5:30 p.m. Pacific Standard Time. It is live. It is virtual. It is free. Free. So if you come and join us, you will walk away not only educated, but you'll understand the home buying process in detail. There's some incentives in there that make it worth your while to go through it. Josh mentioned we did this one in beginning of December. We already got our first deal under contract. It's going to get docs out.
Docs are out,
Docs are out.
gone.
There you go. So we closed 7 of these last year from these workshops. And Josh might not say this right now, but he's told me these people that go through this are his favorite people to deal with.
1,000%.
And that's because they're educated on the process. They understand what's going on. Most of their questions have already been answered. It's a much more enjoyable process for everyone.
It's like having a roadmap. You may not have been there before, but you have the map for how to get there. It makes it much less stressful, easier, more enjoyable for everyone.
In fact, I can't read this. What's the name here, Josh?
That's too Pinchy Don Javio official.
People are going to think that's made up for sure. Anyway,
1968. In case you were confused, which one it was.
They just did it again. Said they were at the workshop. It was full of golden nuggets. So there you go. If you like gold, this is full. I mean, silver's doing really well right now. We did through silver
or
nuggets
gold,
out there.
silver or gold nuggets. I'll take either one at this point.
Yeah, silver's doing really well. So we'll throw that in there as well. Javier is who that is. Anyhow, guys, we appreciate you being here. Happy 2026. We'll see you next Wednesday. Adios.
Amigos.